Eric Gebhardt is the co-founder of Altavest, which he launched in 1997 after building his career in futures and options trading. He earned a BS in Business Administration from the University of Southern California, Go Trojans, and holds a Series 3 and 65 licenses. He also serves on the Dean's Advisory Council for La Sierra University in Zapara School of Business and advises the investment office of the SDA Church. At Altavest, he helped create the ThetaTrader, a platform designed to simplify option strategies and manage trades automatically. Outside of work, Eric enjoys time with his family, vintage cars, biking, and skiing. Okay, Eric, you have until 5 minutes before the hour
Okay,
when we hand out our last of our prizes today. And I'll go ahead and mute myself, and you have the floor.
great. I assume everyone can see the screen okay?
Yep. What are professional option strategies?
Yes.
So you're in business.
Thank you. Thank you, John. Thanks for having me again. Good to hear from you. I always enjoy listening to your presentations. And we are going to talk about professional option strategies and exactly what they are and how we can automatically trade them and put them to use in our uh, day-to-day trading environment. So we're looking at our proprietary algorithm, how it builds spreads. We have trade alerts that you've never seen before. You can reply to those and execute your trades in one touch. So we use automation for risk and profit management. You don't have to babysit, screen watch your trades. We also have a simulator. You can go backwards in time. And then to wrap that all up, it's not just all technology. There are real people behind the scenes. So we have trading coaches, licensed and experienced. We're going to tell you more about that. So remember, we're speculating, and that means we accept risk as we try to profit. So do take a moment and look at that risk disclosure. It's required by regulations to present this, but it is important to keep in mind that you should only use risk capital when trading, and past performance is never a guarantee of future results. So take a screenshot of that if you'd like, and you can read every detail in Word at your convenience. And just a brief comment on Altavest. We're founded in 1997. We are a registered introducing brokerage firm. We've developed our proprietary options technology. We'll display that for you and demo that in just a few minutes. We traded tens of millions of futures and options contracts, and we're registered with the Commodity Futures Trading Commission and also a member of the National Futures Association, and we're located in California. It's possible you've seen us on some other presentations online, some of these other venues, including with John Thomas here at the Mad Hedge Fund Summit. These are great events. And we often get quoted in financial press. For example, MarketWatch here asked us our opinion on the jobs report and gold, for example. So my business partner here, Mike, gave him some commentary just recently. So perhaps you've seen us out there. So now with that out of the way and the introductions out of the way, we'll go ahead and talk about these three trading barriers. And this is based on feedback from working with thousands of clients over the years. So maybe you can relate to these. Maybe even tell me which one you relate to the most in the chat. And number one is maybe too much information, confusion, conflicting targets, narratives, opinions, a lot of clickbait headlines. And this is one I think that kind of summarizes it. You have the top financial firms here in the world essentially giving their projections on the S&P 500. They do that every year. And you'll notice they range anywhere from negative 25% return to a positive 18% return. And the question I always have is, which one are you going to pick? So I don't think this is helpful at all. It's really just confusing. And it's just press, I guess. That's why they put it out there, but it's irrelevant. In fact, it's probably worse than irrelevant. It's probably counterproductive, really. So I think that's just a lot of noise. If you want to look at technical analysis, that's fine. We do some of that too, but I think you can overdo it, like this chart here. According to calculations, the stock market will fluctuate. So my sentiments exactly at times, and that's why we created automation. And I even heard John talk about how they use technology as well. So that's what the smart traders are doing. So how about time? It takes time to make all this work if you try to do it all by yourself. And not many of us in our day-to-day routine have the time and the discipline to have a setup like this guy and actually put it to use and make it work. I mean, it looks great, it looks cool, but is it productive? And do you really have time for that? Not many people do. This guy here says, I trade full time in front of my computer from the market open until the market close, watching positions, looking for trades. Every once in a while, I'm even after market hours. And that's really not reasonable or practical for probably most of us. And here's the third barrier. How about just us? Our humanity, our emotions, we tend to get wrapped up with fear and greed when it comes to money. We ride that emotional roller coaster as we're investing. You get euphoric as things are going great, and then maybe things turn and they get sour, get darker. You capitulate, you wave that surrender flag, you get despondent, and then maybe there's a glimmer of hope, and then you get more optimistic, and you just kind of go back and forth, up and down on that roller coaster of emotions, market cycles, and you want to really try to control your emotions. So it's difficult to do. We understand that. And you've got a lot of competition in the algo-driven landscape. Everything is systematic, machine-driven now. So it's difficult to control your emotion when things are moving so quickly, and your competition really, for the vast majority of the time, are really machines on the other end of your trades. And they don't have emotion. They use automation. They have built-in controls for risk and reward. And 90% of the stock market here, according to JP Morgan, is systematic trading. So they're not looking at, that means basically they're not looking at anything fundamental. They're just computer driven and systematic driven. So how can we use that information to our advantage? So can automated professional option strategies help us compete? And we think the answer is yes. And the first thing to ask is, well, what option markets are we talking about? Well, we're going to look at stock index futures options. And you can use, of course, these options for portfolio hedging, for speculation. And the reason we look at these is because they're highly liquid, and we're looking at the major benchmark indexes. You're familiar with, say, the Russell 2000, which are small cap stocks, the NASDAQ 100, you all know about that with all the large cap tech. And then the S&P 500, of course, you all know about the large cap stocks, the 500 largest by market cap in the country. And let's compare volatility, the stock market index versus individual stocks. And I picked a few examples here, timely. One, Tesla. So in the last 5 years, you can see the volatility in an issue like Tesla. And meanwhile, the S&P by comparison, at least on this graph, the way it's scaled, looks very boring. So for some of the strategies with options that we're going to talk about, you don't necessarily want all that volatility. And that's why we look at the index. And the index can move differently from a particular stock at any given time. Here's Alibaba, the enormous Chinese enterprise internet firm. You've got the S&P up 100% in the last 5 years, and meanwhile, they're down about 50%. So they can behave differently, an individual stock versus the index. Or how about the idiosyncratic moves based on company-specific news? And here's something just yesterday that kind of blew my mind. If you weren't following this kind of no-name company, the symbol QMMM out of Hong Kong, I think they adopted some sort of crypto treasury functionality or something, and the stock went from, I think it was like $10 up to 250 or something, and now it's retreated maybe half of that. But just absurd amounts of volatility there. But even today, look at Oracle, this major large cap tech company, up over 40% in a day. So anyway, Look meanwhile at the S&P 500. It looks like a flat line. So that's why we like looking at the indexes. There's not as much volatility to navigate around. And specifically, we like the E-mini S&P 500 market, as well as all the other E-minis, and we'll show you that in a second and why in the demo. But meanwhile, keep in mind, part of the reason we like it is for simplicity. There's no need to choose from 6,000 different securities. You can just trade one or two or three different indexes and focus on those. And the mini is actually huge, a bit of an oxymoron, but the E-mini S&P 500 futures market outtrades all ETFs around the world by over 2.5 times. So here's what that looks like here. The red arrow, you can see all 6,673 ETFs, global ETFs, the E-mini S&P 500, the average daily dollar volume is 2.5 times greater than all those ETFs around the world. So probably something you didn't know. And then looking at the options on the E-mini S&P 500, I don't have the current 2025 data, but it's growing dramatically. Over 1.5 million average daily in volume for the contracts. So a lot of volume. So we're going to look into a demo, but before we do, I want to show you and introduce you to two letters from the Greek alphabet. And first would be delta, helping to determine probabilities when trading options. Here's the definition of a delta or delta. It's how much does the option value change with a change in the underlying index or asset. And option traders look at it as the approximate probability of that option expiring in the money. Okay, so here's an example. If you've got the delta at 0.25, that means at that moment there's a 25% chance that that option would expire in the money and a 75% chance it would expire worthless. So remember, delta is always moving, fluctuating as prices fluctuate and time moves as well. And here's something important. It is not the probability of a winning trade. So don't look at delta and think, oh, okay, if I buy this option with a 0.25 delta, I have a 25% chance of making money with it. That's not the way delta is really defined. And then theta. Remember, every option has limited lifespan. It's what they call a wasting asset or a decaying asset. And time value goes to 0 on every option. And theta is referred to as time. And it's a negative number. It equals 1 day of time decay. So if an option premium is 10 points and theta is negative 0.05, the next day after that, the premium would decline to 9.95, and the next day after that, 9.90, just purely based on theta decay, is sort of illustrating how that works. And here's an example on a graph. So you have 120 days of time on an option, and you can see the value of that option drops and drops and drops because of time decay, especially in this red area in the last 30 days. You can see it starts to accelerate in terms of how quickly it loses value. So that's what they call the rate of theta decay. So what option strategies are we talking about? We talked about looking at the E-minis, so the stock indexes, so we know what market we're looking at, but what strategies are we going to apply? There's multiple strategies you can apply. And we're going to look at how to trade maybe like an institution does, or a hedge fund, or a large financial firm. And you might want to look at something like an insurance company as an example as well, sort of a real life, more practical example. They get paid premiums to assume risk, and they're selling and they're managing that time along the way. And they reinsure themselves, or they hedge their own risk. And they're consistent and they're patient all along in that process. And they look at math, probabilities, favorable long-term odds are really what they're after. So it's a matter of statistical probabilities and actuarials and all that good stuff when you talk about insurance. They're just using math to determine the probabilities of success or failure. So now Wall Street professionals are trading particular strategies, and they're doing something called multi-leg option spreads. So we're going to look at what the professionals do And let's try to emulate that and do the same thing. And they're using theta decay to their advantage. And they collect premium from buyers, and that will help offset the cost of their strategy. And here's this woman on CNBC, and I quote her later, and you'll get the link and you'll see her name. But she says an option spread is the buying and selling of different contracts. And it's a common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. And here's the key here. She says it's been used by Wall Street professionals for decades. So what does a professional option spread strategy to collect premium look like? Okay, that was a mouthful, but so what is she even talking about? What am I talking about? Well, here's a simple example of a simple spread. Um, Here's the E-mini S&P 500, the blue line moving around. It kind of starts here and then it chops around, goes down, goes up. But meanwhile, you notice this red line and this blue line. This represents a out of the money call spread. And let's assume, when the market was trading here, you sold this out of the money call spread and you collected premium for doing so. So the red line is the call that you sell, and the blue line represents the uh, option that you buy to help cover that position and hedge your risk. So it's just that simple. And then, and I'll go back and explain that. The idea is you want the market to stay basically below that red line in this particular example. So you collect net premium by selling that call spread, and you look for the market to kind of stay below that red line before the expiration period. And we're always going to be out of these positions before expiration date. I should point that out as well. We'll get into that a little more. Now, here's a non-directional strategy. So we talked about some of these comparisons with these big moving stocks and whatnot, and why we like the index. Well, some of these strategies are what they call neutral or non-directional, and you don't want an enormous move for these strategies to work well. So you sell an out-of-the-money call spread and you sell an out-of-the-money put spread, and you do that simultaneously. And the net result is you collect the premium that others are paying you. And for this to work, you want the market to do kind of what it just did here, which is to stay between the red lines, generally speaking, and that trade would work well for you. And then you can see the expiration date to the right, that vertical line there, but you'd close out that position before you reached expiration. Here's a dragonfly. If you've never heard that term, that's okay. We, I guess, coined that term. And it's our proprietary technology is able to actually transact these positions. It's a variation on the condor strategy, and it has 6 legs. And again, we'll show in more detail in just a second, but you have this upper structure here with the calls and this lower structure here with the puts. And you really want the market to stay between essentially those red lines again. And you can see here in this example, the market chopped around, and then this big blue arrow, and you'll see here where this other blue arrow points to this blue box under the RTI. That's the profit taking signal. And that can be automated, so you don't have to screen watch and babysit. ThetaTrader, I'll show you the technology I'm talking about, will be able to track and monitor that for you, and then automatically submit that order whenever you get that profit-taking signal. And you can see the expiration date here as well. So this is closed out well before expiration date. So you'll see the red lines are the options that you sold, and the blue lines are the ones that you bought to hedge or protect those. So that's an example of a dragonfly and what it actually looks like visually. And remember that rookies, this is what rookies do. Let's look at this one quote here. A majority of small-time traders are buying the most basic call and put options, which have a much lower probability of profit versus advanced strategies like option spreads. Okay, so I think that's an important point to remember. And here's the woman that was we were quoting earlier, and this is the article here. And they mention a quote from the CEO of Options AI. Everybody in the business knows that if you're only buying out of the money calls, you're likely going to lose money over time. Okay, so keep that in mind. We don't want to do what the losers are doing. We want to try to emulate what the professionals are doing. So that's the whole point of this presentation. And here's that quote here again by the Options AI CEO. And point this out here. Robinhood, I guess, just went public, so they're doing well. They have a large retail base, and a lot of them are rookie traders. Maybe they're getting more advanced traders on board their platform lately. I don't know, but this is at least from, I think, 2024. I think 11% of Robinhood's monthly active users made an options trade, or 2021, okay. But meanwhile, fewer than 1% executed a multi-leg options trade. So what they're saying here is essentially you've got a lot of new time rookie type traders back in 2021 using Robinhood and trading options because they're not trading spreads. That's how you define who's a rookie and who's not. But this is interesting here. It says the question is not can I trade options, but can I have straightforward access to the option strategies that Wall Street uses? So I think that's the question that we answer with our technology. And the answer is yes, we can offer these advanced strategies, these Wall Street strategies, whatever you want to call them. And so stick around here. We're going to show you in just a second how to interact with our technology. We'll show you how to respond to trade alerts with one touch on your phone or via email or on your dashboard, just touching accept or reject. So very interesting technology to say the least. So we've got these professional option spreads that are created and managed for you by algorithms behind the scenes. And our platform is called ThetaTrader. These are pre-built option strategies. Theta trades are created each day and then presented for your or to your dashboard. And we have these one-touch responsive trade alerts as well that get issued. Bull, bear, flat market strategies. You saw a little bit on the Condor and the Dragonfly, how those are more of a kind of a generally flat market strategy. And there are bullish and bearish strategies, of course. And automation, we looked at the RTI briefly. That blue box showed you the profit signal, and then a risk signal is a red box. So we're going to show you how that works. So we're going to jump into a quick demo here, and I'm going to change gears and switch screens. And if I do this correctly, you'll be looking at my ThetaTrader dashboard. Okay, so I think we're good. So here is the dashboard to ThetaTrader. And this is a demo account I use for presentations like this. You'll notice there are active trade alerts here in this section. There are Theta trades available here. These are open short positions. You can see at a glance right here on your dashboard. And then open bot positions or long positions. So this is where you collect premium when you have these open sold or short positions, and this is when you pay premium. And you'll see your account information here is all presented in your demo account. So this is all integrated with your AltaVest trading account. So keep in mind, this is software technology that we developed at AltaVest for us, for our AltaVest clients. So to use ThetaTrader, you have an account with AltaVest. Okay, and you'll notice there are bullish strategies that are pre-populated, bearish, and then not non-directional or neutral. If you want to use either word, that's fine interchangeably. And you're looking at the E-mini S&P 500, NASDAQ 100, and Russell 2000. So those are the three primary indexes that ThetaTrader is actively engaged with. And before we drill down any further, why don't we look at a couple of examples here of today's Theta trades. Here's an iron condor, and you'll notice that there's one to choose from here on the NASDAQ, but there's none on the E-mini S&P 500, and that's just because the algorithm, excuse me, decided that whatever the numbers and the data suggested wasn't viable enough. So it limited our choices today. And that's fine. Just want to point that out. But we'll go ahead and look at this October week 3 expiration has 38 days till expiration. And this is the NASDAQ 100 or the E-mini NASDAQ 100. And this is an iron condor. You can see the strike prices are pre-selected here. you're selling the 21,800 put and the 25,700 call. And you can see your maximum profit potential on the trade. And then this is something called the targeted annualized return. And first thing I like to do is look at a graph. Maybe I can zoom in a little more, make it easier. So this is what the trade looks like. Here's the current market trading right here. This vertical line is the expiration date. And you can see the out of the money call spread that you're selling and collecting premium, and then the out of the money put spread as well that you're selling and collecting premium for. So that's what the visualization looks like of the trade. And here's all the details. You've got your expiration date, your settlement value, put risk, call risk, commission, capital available, cash required, maximum profit potential, targeted return on cash, and then your targeted annualized return. And then let me drill down. Let's see, maybe is it going to help if I go a little bit bigger? Okay, so you're selling this 21,800 put and you're selling this 25,700 call and you're collecting premium for doing that. So that's the red lines. Those two red lines there are the ones that you're selling. Now look at here. The put option that you're selling has a delta of 9.59, and that would suggest that there's over a 90% probability that this put you're selling to somebody else will expire out of the money. And look at the call, 6.3%. So that's over a 93% probability, according to the delta, that this call you're selling to someone else is going to expire out of the money. So that's a big part as to why the algorithm selected these particular strike prices. It also looks at time till expiration. It looks at proximity to the market, some other variables as well behind the scenes. But generally speaking, you're going to see this type of trade and this type of setup where these deltas are going to be quite low. And you'll see here that it defaults to a sell because you're selling the spread to someone else. You want them to basically you collect the premium as they buy it, so you're selling it to someone else, and the quantity defaults to 1 when you look at any of these trades. But you can, of course, increase that. You'll see all the numbers change, go up and down, and you can change the amount of premium that you want to try to capture, or go back to the original model. And you'll notice that quite simply, you can select your quantity, keep the price. You could also change these strikes if you wanted, but most people don't, and I think with good reason. Just go with what the algorithm suggests. Okay, and then we'll go ahead and just place these 5 here and give an example of how quickly and easily you can do that. So in this case, it just assumes you're filled because it's a demo. And then we'll look at, let's go back to the dashboard here in a second. But what I want to do too also is show you these trade alerts and how they work. And then we're going to run through some simulations. I've got some here that I've sort of preloaded to save time. Give this just a second, folks. We looked at a condor, and then we'll next look at this dragonfly. I don't know why it's taking so long, but let's refresh that. Seems to always happen during a webinar, doesn't it? But that's okay. In fact, I can use this time to show you, you see these 2 alerts here. They're both for a dragonfly. And I'll show you right here. Here's one, today's model, October week 3 NASDAQ 100 dragonfly spread. You see it has 38 days till expiration. And so you get a trade alert. It'll show up on your dashboard, just like you see. And let me break down the dragonfly. It's probably a good example to slow down and show you the quantity and the structure. So a dragonfly is always going to sell 4 calls and 4 puts. And then let's say you sell these 4 calls here, then you buy 3 further out of the money calls, and then 1 closer to the money call. So for every short call you have a long or a bought call. So it's covered. It's completely covered. There's no naked options. And it's the same structure with the puts. You sell 4 and you buy 3 further out of the money and then 1 closer to the money. And the key here with the dragon is you notice this 1 call that you own and you buy is quite a bit closer to the money compared to the 4 that you've sold. And so the delta is higher and you own it. So if the market starts moving higher and higher, the value of this option is going to move higher more quickly compared to the 4 that you sold. And the same thing with the put. So it acts as additional insurance or as an additional hedge, but it does cost you money. So you buy this and you buy that as additional insurance, and it minimizes or lowers your profit potential a bit. However, it makes the trade more robust in many circumstances, and it also allows you to sometimes not take a loss versus a condor. And also, it can also give you a chance to get out of a trade quicker compared to a condor. So I'll show you that in a second, but here we go. So we're going to look at the dragonfly for this NASDAQ position. We looked at the condor. And I don't know if you recall, but the targeted annualized return on the condor was just over 100%. And you see the dragonfly for the same expiration is about 85%. And again, that's because of the trade structure that we just kind of briefly looked at here, because you pay money to buy this call and buy this put, and that's an additional hedge or additional insurance on that position, and it costs you money. So that's the reason why. And we'll look at a graph. So here's today's dragonfly, the week 3 October expiration. This is what it looks like. You see the vertical line there is your expiration, and you're selling these 4 25,600 calls. You're buying 3 of the 25,800s, and then you're buying 1 25,400. And the distance between these calls and these puts isn't always the same as what you're seeing here, depending on market conditions. So the algorithm is choosing that for us and said that this is really optimal. It's optimized. And you'll notice again the same details here: days till expiration, put risk, call risk, commissions, capital, cash required, so on and so forth. I won't go into every detail, but you've got your quantity all defaulted at 1, and you're selling the spread to someone else. You're trying to collect 36.75 points for a maximum profit potential of 651. And again, the delta on this, 9.59, and this delta here, 7.53. So you've got over 90% probability this put would expire out of the money, and 93% or so, 92% probability that this call you're selling would expire out of the money. So we'll go ahead and change this, and maybe we'll do, say, 3 of these and place that order. And it's just that simple. It shows up as being filled in the demo account. So we'll go back to the trade alert. Let me just go back here. Okay, so you're going back to this trade alert, and it already selects the quantity for you. And that is based on the balance in your account and also what other position you have in your account, whether it's a similar expiration or similar strikes. And you can adjust this quantity if you want. You can go lower, but you cannot go higher and actually increase your exposure or increase the risk. So that's a nice feature there if you want to kind of modify the alert just based on the quantity. And you'll see the entry price is pre-selected. This is the premium being collected here. Cash required, days till expiration, and you can either accept it or reject it. And we'll just go ahead and accept that. And it's just that simple. You can see the order there having been accepted. And now let me go back, squeeze this down just a notch here. And let me show you this section here for the trading simulator. There's a trade simulator here, and I've got a couple lined up. We're going to demonstrate the difference between a condor and a dragonfly. At times, there is a difference. So here's July 1st. 31 days till expiration. This is the July end of month expiration E-mini S&P 500 Condor. So again, that's a mouthful, but it the algorithm makes it certainly much easier when it pre-builds these things. And you can use these buttons here to go backwards and forwards in time. And as you can see, day by day, this is the market price changing. See the P&L of the position, negative initially, and that makes sense because theta decay hasn't worked yet. And that's pretty normal for these types of trades. And we'll go ahead and just play this here. And the RTI is green, and that means good, do nothing. Just let theta decay work. So still do nothing, even though the market's starting to edge a little closer, a little higher to the upper boundary on those short calls, but still do nothing. And then here, with 3 days till expiration on July 29, you get a blue RTI, and that means take profits. And you can automate this, and I'll show you how to do that. So if you get a profit-taking signal on any position, ThetaTrader scanning, looking for that, and it will submit that order for you to close out that position. So remember that July 29, 3 days till expiration, and that was the Iron Condor. And so here's the same day you place a trade for the July end of month expiration. Instead of a Condor, you did a Dragonfly. So let's compare the two. And look at the big difference here, folks. You get a blue profit-taking signal with 15 days till expiration. So this matured much more quickly. So this was July 17, you get a profit order. You had to wait till July 29 to get a profit order with the Condor. So that's a big benefit oftentimes with a Dragonfly. The structure of the Dragonfly lends itself to getting out of a trade earlier compared to a Condor. And that, of course, is beneficial because you can keep your money moving on to the next trade. So that's a big difference. Now let's look at another one here. This is from April 30, and it's an end of month May expiration, and it's a Condor. I actually kind of forget what happens here. Okay, so this starts running up, getting very close to the red line very, very quickly. And you can see the risk is elevating. Yellow means higher risk, but do nothing. Orange is even higher, but still do nothing. And then it turns red. So it said, get out. There's too much risk. Take your loss on this position and move on to something else. So this Condor ended up being a losing trade. And of course, they happen. If you're going to trade, you're going to have losses. So this is the May end of month expiration, the Iron Condor, and that was placed on April 30. So I just want to make sure we're doing apples to apples. So here you go, April 30, the May end of month expiration. So instead of a Condor, we're going to do a Dragonfly. So remember the Condor here ended up being a losing trade, and that's your signal here on the 19th. So obviously the market is doing the same exact thing, but you have a Dragonfly instead of a Condor. And look at that. Even though you had an orange RTI, that means elevated risk, it still didn't tell you to get out. And that's because you own this particular call option right here. And it's actually acting as a hedge or additional insurance. And it's actually kept you in that position, kept you from taking that loss, and then you get a profit-taking signal with a couple days before expiration. So instead of taking a loss like you did on the Condor, had you done a Dragonfly, you would have been able to withstand that pressure and end up actually, instead of a losing trade, having a winning position. So you can see the Dragonfly can be more robust in certain circumstances. It's not always going to do that and behave that way because at times you will have a loss with the Dragonfly as well. But typically the losses will be less frequent and they won't be as well. They'll just certainly be less frequent. So here's something as well. Just want to point out we can do bullish strategies for all these indexes, and these are all pre-populated with some other strategies, butterflies and so forth, if you're familiar with those. You don't have to do an entire Dragonfly. You could do, for example, just the put side of a Dragonfly, or you could do just the call side of a Dragonfly, and that's called a half Dragonfly. So that's more of a directional strategy. And here's something that I wanted to point out. If you are, well, for example, you have a portfolio of equities and you're concerned that there's going to be, between now and the end of the year, there's going to be a sell-off, but you don't want to sell your equities. Well, there are strategies you can use to hedge. You can simply buy some put spreads. Those usually cost a bit of money though, or you could do something called a bear hedge. It's a combination trade, and that's what I want to show you right here. And let's see, where was it? Here it is. So a bear hedge is essentially selling an out of the money call spread, and you use that money that you've collected to buy an out of the money put spread. So you can finance the purchase of a long put spread by selling an out of the money call spread. So you can usually do these types of things. And there's also a bull hedge too. You don't have to just be bearish, but you can usually do this strategy for even money or even a credit. So it doesn't cost you anything to have the strategy in place. And we'll look at, here's an example. You can see this was back in early April. You put on a bear hedge, the market starts to drop immediately. And, this trade is obviously going to work out, very well. And then you could close out that position. Here's the expiration date here. So just an example of how you could have a bear hedge. And then, you could get out of that whenever you wanted. But just, let's see here, go back. Yeah, and then the bull hedge as well. So anyway, I just wanted to give you an idea of what's available. You've got the neutral strategies, the spreads, and then you also can use directional strategies as well with spreads. And let me show you, we have daily research, something called TradeScope. We put that out every afternoon on the indexes. So we just give a little bit of a simple technical review on the major indexes, but then we also have the market outlook looking ahead here. And then oftentimes when there's a FOMC ahead, we'll start kind of posting the probabilities on the various rate cuts here. So you can see there's over a 90% probability you're going to get 25 points. So anyway, 50 points, I think we're at 6.2% probability of a 50-point cut next week. But, probabilities are no guarantee. So we'll see. And let me show you how to make the automation occur. So you go to under my account, under settings, and you will click activate risk manager right there. And you can also customize the risk manager just a bit. So right now I have the default setting whenever the RTI turns red. You can see that's the default level of risk here. And you could change that to orange, or you could use a custom level anywhere from 50 to 25. Now I want to point out, if you went down below 50, anywhere below 50, you're going to increase the frequency of actually a losing red RTI signal. So you'll increase the frequency of losses, but the losses will be smaller in magnitude. So you're free to do that. And there's no right or wrong answer necessarily. It just sometimes personal preference. But I'll just go ahead and leave our account here at the default setting of 50. So hopefully that makes sense. And let me know in the chat there if you have questions about that. And then the profit directive, same thing here. Just check that. And then you would just save your settings on the profit directive and the risk directive. So that's it. Then once you do that, everything is automated in terms of where you exit those positions. And there's a great help file here as well under the My Account section. And there's a glossary which explains all of the color coding for the RTI. It's all right there. And it won't, spend time on all the details. We also have a help file for placing trades and navigating the website. And then we also have an education package available here. And I'll show you more about that in just a few minutes. But all available, sort of a master class here on videos, tutorials on education. And so this is a great section here this help file and all of the videos and education and all the interface with ThetaTrader. But let me go back and let me show you here how to look at your closed positions. Oh, and I should point out as well that everything in ThetaTrader, all of the calculations and all of the numbers and all the results are net of all trading cost and commissions. So keep that in mind. I should have made note of that earlier. And let's see, where was I going? Oh, okay, here we go. We're going to go to closed positions. So you can look at your closed positions. You can filter by any market or any time frame that you want, but the default setting just keeps the last 20 on the page here. So you'll notice total of 20 trades on the page, 17 winners, 3 losers. This is the total profit out of all the 20. And 14 here were short or sold positions where we're collecting premium, and there were 0 losses. So that's where the majority of the gains came from. Now, that sort of makes sense when we talk about how professionals are selling premium and collecting premium. So that's where you're going to have the probabilities in your favor over the long period of time. But I should also point out that this example on this page, the 20 here that are showing, this is just a demo account and I randomly place trades. So I'm not suggesting you're going to have 14 or 14 winners if you sell premium. You're going to have losers over a period of time. This just happens to be a window, back to mid-July or so to current, where the short positions have all worked out just fine. And you can see why, because if you look at the indexes, they've kind of gone sideways to slightly higher, kind of grinding higher. No real dramatic moves. And you'll notice the bot positions are total of 6. And there were 3 winners and 3 losers. And so that's kind of how you go back in time and you can look at any of your positions. Here's an example of selling 10 iron condors. If you want to go back in time, you can see here, this was August 4. It had 47 days till expiration. You place the trade and you can see it's red, but yet the RTI is green and yellow. It says do nothing. In other words, this is working great. Even though it's red, you have this large room of in margin for error, and you can see you get your profit taking signal. So you see you have this large margin of error. So that's the benefit to these types of spreads. And just wanted to point that out on the closed positions there. And this is how you access the trade simulator. We looked at some examples. You can go backwards in time. Let's see here. You can go backwards in time and select any date. You can go back as far as about 10 years. We keep it rolling at 10 years. And then you select the dates, and then you can go back and choose any strategy and then see how it would have played out. So that's a lot of fun. And then I should also point out that let's say on the trade simulator, you don't have to use this play button to go, back and forth one step at a time, real slow. You can just go right to the end. So you can just go open up a simulation and then just click one time and then get your result. So speed it up quite a bit. So it's a lot of fun and valuable. It's a valuable tool. All right, folks. And so you saw the trade alerts here, and let's look at this trade alert as well. So here's another trade alert, November week 3 Dragonfly spread. And again, same types of data that you're familiar with. You'll notice the structure of that Dragonfly, the calls and the puts. You do this all simultaneously as one order, all 6 legs. So you have 3 strikes here for the calls and 3 for the puts. And we have technology, ThetaTrader, that I've not seen anywhere else that can do this simultaneously. I've seen others do a Dragonfly and they do it in 2 separate orders. So very difficult. They try to leg in and leg out. But with us and our technology, it just happens as one order at one price. So, all right, folks, let me show you how to do a trade alert now. So let me switch gears here. a trade alert on your phone, I should say, to clarify. All right, so you are back now. So we're going to show you how to respond to a trade alert with one touch. So you're going to have your phone and you'll receive a trade alert. And again, you simply touch accept, and those alerts are then, orders are then placed. So this is what it would look like. You'll get a text message from us, and there'll be a link, and you'll touch that link. And it'll take you directly to the alert page. So this should look familiar. This happens to be a butterfly. And I'm sorry, not a butterfly, a dragonfly. Too many insects. 66 days till expiration. You see the calls here. You see the puts. The quantity is pre-selected. You see the entry price there, 9.6. You see the premium being collected. Quantity is 7. You could change the quantity by going down if you wanted. You can't go higher. You can't increase your risk. So we just change that to 5, just to illustrate how this works. And then we just touch accept. So that's how simple it is to use the trade alerts, whether you receive the alert on your phone, you'll also receive them via email, and then they'll show up on your dashboard on your ThetaTrader account. Okay, so that is the demonstration of ThetaTrader, and let's show you how to get started here. We've got a few minutes to wrap it up. So with ThetaTrader, you get the software, the RTI, the trade simulator, everything for valued at $3,500, plus the trade alerts. You saw how efficient those are, valued at $4,464 for the trade alerts. So all that technology, plus the private coaching, that's us. We are licensed and experienced. Private coaching can cost anywhere from $5,000 to $15,000 just for a 6-month or 12-month period of time. But with ThetaTrader, we include your private coaching. We value that at least at $10,000, someone to be a co-pilot with you. So the technology, including the alerts, the coaching, valued at over $18,000. And then we have our daily TradeScope newsletter. We showed you that briefly. I reviewed the video, the masterclass videos there. So here are the topics: futures, stock indexes, options review, futures options, stock index spreads, and then advanced strategies. So that's all part of the masterclass video series, valued at almost $2,000. So all of that research, $2,900 value. Then we have the online tutorials. I briefly reviewed that as well. So you have the software, you have the alerts, you have the coaching, and you have the masterclass research and education, valued over $21,000. And of course, that's not what we're going to offer that at. We did offer these at $4,000 in live presentations, in-person presentations, in seminars and events, and people would sign up at the back of the room. But we love these webinars, and we'd like to address a lot of people via these webinars, so we can offer this at much greater value. So this is our MAD price here, one-time payment of only $597, and that's a lifetime membership. So you can use the QR code or just type in cf.altivest.com/MAD, and that will get you right to the sign up page. Take a picture of this page if you'd like, or slide, and you got my phone number and email there. There's a 30-day guarantee on this, so there's no risk on your membership fee. Sign up, and I think you're going to like it. But if you don't, that's okay. We'll cancel the membership and then refund that to you. Then if you want a free membership, that's fine too. People love to take us up on this offer. You have an account with us, $100,000 or more, and then we'll just rebate the entire membership, $50,000 or more, and then you get a 50% rebate. So take advantage of that, folks. Again, advantages in trading the ES options, for example, lots of strike prices, granularity, and the coverage that we need, all the maturities that we need, that ends up in superior execution according to the CME group, cost savings of $4 to $15 per contract compared to the SPX options. You get that tight bid-ask spread. There's no margin calls with AltaVest because everything is covered. So no margin calls. There's the joke here. She says, whose margin and why does she keep calling you? So don't worry about that with us. We're doing covered strategies. There's no day trading restrictions when you're trading futures options. Won't get into all the details, but another benefit, there's tax efficiency advantages here. When you're trading futures options, 60% of your gains are taxed at your lower capital gains rate, but always consult your tax attorney, of course. I won't get into this example. We're just kind of run low on time. I don't want to go too late here, but I think you get the idea. There's no more itemizing as well. And you can trade futures and options with a self-directed IRA. We work with Equity Trust. They have over 71 billion in assets under custody and administration, and they will waive your setup fee for AltaVest. So that's great news. And you can do other things too. We don't have to just do the E-mini options. We do lots of metals and gold, and it's an efficient way to use your capital. 20-to-1 efficiency rating ratio here compared to ETFs and stocks with 2-to-1. So we think it's an alternative solution, a great way to maybe try to make some money and beat inflation. We like gold a lot, silver, platinum. You've got inflation here, that blue line that kind of looks like the real rate of inflation. And look at the price of gold, just kind of moving along that same slope. Alan Greenspan likes gold. We won't get into it here, but this was gold was at $1,800 when he talked about it in February 2 years ago. Best performing asset class of the last 20 years, it's been gold, believe it or not, and even in the last 2 years. And keep in mind, stock market drawdowns can last decades. Here's the NASDAQ, dropped 80% from its peak. And if you were unfortunate to buy at the wrong time, took you 15 years to recover if you were passive and just sat on it. So we like the idea of having alternatives. That's what the options trading allows you to be flexible. So here are the benefits of ThetaTrader. You see all of that there and a lot of information. You probably got questions. I'll leave the last slide up here and I don't want to go over my time limit. So if there's any questions, put them in the chat. And otherwise, that is a wrap, folks. That was a lot of fun and hope you all enjoyed it and love to hear from you all. So feel free to reach out if you have any comments or questions. And if you want to get signed up, there is the link and we've got that 30-day guarantee.
All
So
right,
that will do it.
Eric. Outstanding as always. You're a real professional. Um, Again,
Thanks,
to take
John.
advantage of Eric's offer, please look at the blue link in the chat box on the right. That'll take you to the dedicated sales page that is only available today. Uh, okay, so Eric, see you in December, I think.
Yeah, look forward to it. Thank you for
Yeah.
having me, everyone.
Okay.